This chart tracks the percentage of global reserves held in US dollars. In the year 2000, it sat at a comfortable 71%. Today, that number has dropped below 58%, hitting levels we haven't seen since 1992. Yet, despite this massive drop in demand, traditional financial media is entirely silent. There is no breaking news, no market panic on Wall Street, and no panicked traders hitting the sell button. The dollar ascended to global dominance by default. In 1945, while the industrial centers of Europe and Asia lay in ruins, the United States stood as the world's only functional economic powerhouse. Because every other country needed dollars to rebuild and trade, they were forced to buy U.S. bonds. This arrangement gives America access to the cheapest capital on Earth, saving the government an estimated $200 billion every single year. Reserve currency status functions as the hidden, structural engine of the American economy, far outweighing its role as a mere banking statistic. To see how this engine works, look at the plumbing of a standard international trade. If Brazil and China want to do business, they rarely trade directly. The payment path is forced to detour through a correspondent bank in New York. This mandatory detour provides the United States with total visibility into global trade data. It grants Washington a real-time view of exactly who is shipping what and where across the planet. Furthermore, because every nation must hold these dollars to clear their transactions, they are essentially forced to buy U.S. Treasury bonds. This constant global demand effectively funds American debt at a massive discount. Physically routing these payments through New York also establishes the United States as the world's supreme regulator. It allows Washington to freeze accounts or sever entire nations from the financial grid at its own discretion. In 2022, the U.S. flexed this regulatory power to its absolute limit. They froze roughly $300 billion in Russian sovereign assets and cut the country off from the SWIFT international banking network. That move sent a clear signal to every central bank on Earth. It proved that the financial infrastructure they depend on can be switched off in a matter of seconds if they cross Washington. That realization sparked a coordinated effort to build an alternative. It started with BRICS, a coalition of emerging economies that recently expanded to include massive oil producers, now representing over a quarter of the entire global economy. Together, these nations are building new financial plumbing. The first tool is a blockchain-based cross-border payment platform called mBridge. Look at the Brazil to China trade route again. mBridge functions as a direct pipe, allowing countries to settle trades with each other without ever touching a U.S. correspondent bank. To bypass the need for U.S. treasuries, they are piloting a settlement tool called the unit. Instead of relying on the dollar, it provides a neutral measuring stick for trade, backed 40% by physical gold and 60% by a basket of local currencies. The real target here is price discovery. Currently, physical commodities like oil are overwhelmingly priced in dollars. As long as every barrel is quoted in USD, American currency is baked into the baseline of global trade. mBridge and the unit function as precision strikes. They are engineered to break the United States' monopoly on transaction control and global pricing. Central banks aren't waiting for pilot programs to conclude. Since 2022, they have been buying physical gold at the fastest pace in modern history. We are seeing a surge in localized deals. Brazil and China recently signed an agreement to settle bilateral trade in yuan and reals. Soon after, India completed its first ever purchase of crude oil from the UAE using Indian rupees. Even Saudi Arabia, the cornerstone of the petrodollar system for the last half-century, is now openly discussing accepting Chinese currency for its oil sales. None of these individual deals can replace the dollar on their own, but combined, they show a coordinated rewiring of the global financial system is actively underway. The US dollar is not going to suffer a sudden overnight collapse, nor will a single alternative, like the Chinese yuan, step in and take its place entirely. Monopolies rarely die from direct replacement. They die from optionality. For the last 80 years, the world used the dollar because no other functional system existed. It held a structural monopoly over global finance. For the first time since World War II, viable alternatives exist. As emerging markets slowly route their trades through new networks, the United States will lose its visibility into global data. It will lose its regulatory chokehold, and eventually it will lose the cheap debt that fuels its status as a superpower.